The shift did not begin with a crash, and it did not announce itself with panic, but the data started to move in ways that could no longer be ignored. Across the United States, small changes in pricing patterns, inventory levels, and buyer behavior began to form a larger picture, one that suggested the housing market was no longer operating under the same conditions that defined the previous few years. What had once been a fast-moving, highly competitive environment gradually slowed into something more deliberate, more cautious, and far more uneven depending on location. In the years immediately following the pandemic-driven surge, demand had remained unusually strong, supported by low mortgage rates and a wave of migration into suburban and lower-cost regions. Buyers competed aggressively, often offering above asking price, waiving contingencies, and closing deals within days. That environment created rapid price appreciation across nearly every state, compressing affordability and pushing many households to the edge of their financial limits. But markets built on accelerated momentum rarely sustain that pace indefinitely, and by the time interest rates began to rise meaningfully, the imbalance between affordability and pricing had already become difficult to maintain. The first signs of change appeared in the pace of sales. Homes that once sold in a matter of days began to sit on the market for weeks. In some regions, particularly those that experienced the sharpest price increases, listings accumulated faster than buyers could absorb them. This did not immediately translate into falling prices, but it altered the negotiation dynamic. Sellers who had previously dictated terms found themselves adjusting expectations, offering concessions, and, in some cases, reducing asking prices to attract attention. At the same time, the cost of borrowing introduced a new layer of pressure. Mortgage rates, which had remained historically low for an extended period, moved upward in response to broader economic policy aimed at controlling inflation. This shift significantly reduced purchasing power. A buyer who could afford a certain price range 1 year earlier now faced higher monthly payments for the same property, effectively shrinking the pool of qualified buyers. This contraction in demand was not uniform across the country, but it was consistent enough to influence national trends. Regional variation became more pronounced as the market adjusted. States that had experienced rapid inbound migration during the earlier boom began to show signs of saturation. Inventory levels increased as more homeowners attempted to capitalize on previously high valuations, while new construction added additional supply to the market. In contrast, regions with more stable, slower growth patterns exhibited less volatility. Prices in these areas did not rise as dramatically during the boom, and as a result, they did not face the same level of downward pressure during the shift. Another factor contributing to the changing landscape was the behavior of existing homeowners. Many individuals who secured low mortgage rates in previous years became reluctant to sell, knowing that purchasing a new home would likely involve a higher borrowing cost. This phenomenon constrained supply in certain segments of the market, particularly for mid-priced homes, and created a divide between new listings and existing inventory. While some areas saw a surge in available properties, others remained relatively tight, further complicating the overall picture. Buyers, meanwhile, adopted a more cautious approach. The urgency that once defined the market gave way to increased scrutiny. Prospective homeowners began to compare options more carefully, negotiate more assertively, and in some cases, delay purchasing decisions altogether in anticipation of potential price adjustments. This shift in mindset played a critical role in reshaping market dynamics, as the balance of power moved incrementally away from sellers. The data reflected these changes in measurable ways. Metrics such as days on market, price reductions, and inventory growth began trending upward in multiple regions. At the same time, year-over-year price growth slowed and in certain areas reversed. These indicators did not point to a uniform decline, but rather to a transition phase, where the market was recalibrating after a period of exceptional expansion. What made this shift particularly significant was not the magnitude of any single change, but the convergence of multiple factors occurring simultaneously. Interest rates, affordability constraints, shifting migration patterns, and evolving buyer behavior all contributed to a more complex and less predictable housing environment. The result was a market that no longer moved in one direction, but instead displayed varying conditions across different states and regions. Understanding this transition requires moving beyond simplified narratives of boom or bust. The housing market was not collapsing in a uniform sense, nor was it continuing its previous upward trajectory without interruption. Instead, it was entering a phase defined by adjustment, where pricing, demand, and supply were gradually aligning with new economic realities. This process, while less dramatic than a sudden downturn, carried significant implications for buyers, sellers, and investors alike, setting the stage for a new chapter in the U.S. housing landscape. As the shift continued to unfold, regional differences became the defining feature of the housing market, revealing that the national narrative could not be understood without examining local conditions. States that had experienced the most rapid growth during the previous expansion began to show the clearest signs of cooling, not through abrupt declines, but through a steady accumulation of subtle changes that reshaped expectations. In parts of the Sunbelt, where population inflows had driven significant demand, the balance between supply and demand began to tilt. Cities that once attracted buyers with relatively affordable prices and strong job growth saw an increase in new listings, partly due to homeowners seeking to lock in gains and partly due to ongoing construction projects reaching completion. This expansion in supply coincided with a moderation in demand, as higher mortgage rates reduced affordability and slowed migration patterns. The result was a noticeable increase in inventory, which in turn reduced the urgency among buyers and introduced greater competition among sellers. In contrast, many areas in the Midwest maintained a more stable trajectory. Because price growth in these regions had been more measured during the boom, affordability remained comparatively intact. Buyers in these markets were less affected by the same level of financial strain, allowing demand to persist even as national conditions tightened. Inventory levels in these areas did not rise as sharply, and while sales activity slowed somewhat, it did not exhibit the same degree of volatility seen in faster-growing regions. The West Coast presented a different dynamic, shaped by both high price levels and sensitivity to interest rate changes. In markets where home values had reached elevated levels, even small increases in borrowing costs translated into significant changes in monthly payments. This sensitivity amplified the impact of rising rates, leading to a more pronounced slowdown in buyer activity. Properties remained on the market longer, and price adjustments became more common, particularly for homes that had been initially priced based on peak conditions. The Northeast, with its mix of dense urban centers and established suburban communities, showed a more nuanced pattern. Some cities experienced renewed interest as buyers reconsidered proximity to employment hubs, while others faced challenges related to affordability and shifting work patterns. The interplay between remote work trends and traditional commuting preferences continued to influence demand, creating pockets of strength alongside areas of stagnation. Underlying these regional variations was a broader shift in how market participants interpreted risk. During the earlier phase of rapid growth, expectations of continued price increases encouraged buyers to act quickly, often prioritizing access to property over long-term cost considerations. As conditions changed, this mindset evolved. Buyers became more attentive to pricing fundamentals, interest rate trajectories, and local economic indicators. This shift in perspective reduced speculative behavior and reinforced a more measured approach to purchasing decisions. Sellers, in turn, faced a different set of challenges. Pricing strategies that had proven effective during periods of high demand no longer guaranteed quick results. Overpricing a property increasingly led to extended time on market and eventual price reductions, signaling to potential buyers that negotiation opportunities existed. This feedback loop contributed to a gradual normalization of pricing behavior, where initial listing prices aligned more closely with market realities. The role of new construction also became more visible during this phase. Builders who had initiated projects during periods of strong demand found themselves delivering inventory into a market that was no longer expanding at the same pace. In response, many offered incentives such as rate buydowns or price adjustments to attract buyers. These strategies, while effective in maintaining sales volume, added to the overall supply of available homes and influenced pricing dynamics in surrounding areas. Another important element was the rental market, which interacted with the housing market in complex ways. As homeownership became less accessible for some buyers due to higher borrowing costs, demand for rental properties increased in certain regions. This shift supported rental prices but also delayed the transition of renters into homeowners, further moderating demand in the purchase market. The cumulative effect of these factors was a housing environment characterized by segmentation rather than uniformity. Different regions, price tiers, and property types responded to changing conditions in distinct ways, making it increasingly important to analyze the market at a granular level. Broad national averages masked these differences, highlighting the need for more detailed examination to understand the true nature of the shift. This evolving landscape underscored a key point. The housing market was not simply moving from growth to decline, but rather transitioning into a phase where multiple forces interacted simultaneously, creating a range of outcomes across the country. Recognizing these patterns provided a clearer framework for interpreting current trends and anticipating how the market might continue to adjust in the months ahead. As the market continued its transition, the relationship between affordability and demand became the central force shaping outcomes across the country. While inventory levels and regional dynamics played significant roles, the fundamental constraint facing buyers was the cost of financing, which influenced nearly every aspect of purchasing behavior. This constraint did not operate in isolation, but interacted with income levels, price expectations, and broader economic conditions to determine the pace and direction of market activity. The increase in mortgage rates effectively redefined affordability thresholds. Monthly payments for newly financed homes rose even in cases where prices remained stable, altering the calculations that buyers used to determine what they could reasonably afford. This shift had a cascading effect, particularly in markets where prices had already reached elevated levels. In such areas, even modest increases in borrowing costs translated into substantial changes in monthly obligations, pushing some buyers out of the market entirely while forcing others to reconsider the size or location of their intended purchase. This recalibration of demand did not occur evenly across all price segments. Entry-level homes, which traditionally attract first-time buyers, experienced a unique set of pressures. On one hand, limited supply in this segment supported pricing, as fewer existing homeowners were willing to sell and relinquish favorable mortgage terms. On the other hand, the very buyers who typically drive demand in this category faced the greatest affordability challenges. The result was a constrained environment where transactions slowed despite underlying demand remaining present. In higher price segments, the dynamics differed but were no less complex. Buyers in these categories often had greater financial flexibility, but they were also more sensitive to broader economic uncertainty. Changes in equity markets, employment stability, and investment returns influenced their willingness to commit to large purchases. As a result, demand in this segment became more selective, with buyers placing greater emphasis on value, location, and long-term potential rather than short-term market momentum. Investor activity also shifted during this period. In earlier phases of rapid growth, investors played a significant role in driving demand, attracted by rising prices and favorable financing conditions. As those conditions changed, the calculus for investment purchases became more conservative. Higher borrowing costs reduced potential returns, while increased inventory in certain markets introduced greater competition. This combination led to a moderation in investor-driven transactions, which in turn affected overall market liquidity. The interaction between supply and demand during this phase revealed an important characteristic of the housing market. its tendency to adjust gradually rather than abruptly. Price declines, where they occurred, often followed a sequence of events rather than appearing suddenly. Homes remained on the market longer, sellers adjusted expectations, and transactions occurred at slightly lower prices, creating a downward trend that unfolded over time. This process contrasted with the rapid appreciation seen during the earlier boom, highlighting the asymmetry between upward and downward movements in real estate markets. Another dimension of the shift involved the expectations of future conditions. Both buyers and sellers began to incorporate forward-looking considerations into their decisions, evaluating not only current prices and rates, but also the likelihood of future changes. This forward-looking behavior introduced an additional layer of complexity, as perceptions of future interest rates, economic growth, and housing supply influenced present-day actions. In some cases, buyers delayed purchases in anticipation of potential price adjustments, while sellers hesitated to list properties, expecting conditions to improve. This interplay of expectations contributed to a temporary slowdown in transaction volume, even in markets where underlying demand remained relatively strong. The reduction in activity did not necessarily indicate a lack of interest, but rather reflected a period of adjustment, where participants recalibrated their strategies in response to changing conditions. Over time, as expectations aligned more closely with reality, activity levels began to stabilize, albeit at a different pace than during the peak of the market. The role of policy and macroeconomic conditions also remained a critical factor. Decisions related to interest rates, inflation control, and economic stimulus influenced the broader environment in which the housing market operated. While these factors were not directly controlled by market participants, their impact was felt through changes in financing costs, employment conditions, and consumer confidence. Understanding the housing market during this phase required considering these external influences alongside more localized factors. Ultimately, the market's trajectory during this period was defined by its ability to adapt to new constraints. The conditions that had supported rapid growth were no longer present, but the underlying demand for housing remained. The challenge lay in reconciling that demand with the realities of affordability and supply, a process that unfolded unevenly across regions and price segments. This ongoing adjustment set the stage for the next phase of the market, where the balance between stability and further change would become increasingly important. By the time the market reached this stage of its transition, it had become clear that the defining characteristic was not volatility in the traditional sense, but rather a sustained period of recalibration. The elements that once moved in alignment, low rates, high demand, limited supply, had diverged, creating a more complex environment in which outcomes depended on the interaction of multiple variables rather than a single dominant trend. One of the most notable developments during this phase was the normalization of time. Transactions that once occurred rapidly began to follow a more extended timeline, allowing for greater deliberation on both sides of the process. Buyers conducted more thorough evaluations, comparing properties, negotiating terms, and considering long-term affordability. Sellers, in turn, adjusted to a market where immediate offers were no longer guaranteed, requiring more strategic pricing and greater flexibility in negotiations. This shift in tempo had implications beyond individual transactions. It influenced how market data was interpreted, as shorter-term fluctuations carried less weight in a slower-moving environment. Analysts and participants alike began to focus on broader trends, examining changes over months rather than weeks to understand the direction of the market. This longer perspective provided a more accurate reflection of underlying conditions, reducing the likelihood of overreacting to temporary variations. At the same time, the concept of equilibrium began to re-emerge. After a period characterized by imbalance, where demand consistently outpaced supply, the market moved toward a state where these forces were more closely aligned. This did not imply a perfect balance, as regional disparities remained significant, but it suggested a departure from the extremes that had defined earlier phases. In practical terms, this meant more predictable pricing, fewer bidding wars, and a greater emphasis on fundamentals. The role of demographics also became increasingly relevant. Long-term trends, such as population growth, household formation, and generational shifts, continued to influence housing demand. These factors operated independently of short-term market conditions, providing a baseline level of activity even as cyclical elements fluctuated. Understanding the interplay between these structural drivers and immediate economic factors was essential for interpreting the market's direction. Another aspect of the evolving landscape was the differentiation between property types. Single-family homes, condominiums, and newly constructed properties each responded differently to changing conditions. In some areas, single-family homes retained stronger demand due to their perceived long-term value, while other segments experienced more pronounced adjustments. This differentiation added another layer of complexity, reinforcing the importance of detailed analysis rather than broad generalizations. As the market moved forward, the question was no longer whether it was shifting, but how that shift would settle into a new pattern. The possibility of further adjustments remained, particularly if external conditions such as interest rates or economic growth changed significantly. However, the trajectory suggested a move toward stability rather than continued acceleration or abrupt decline. For buyers, this environment offered both challenges and opportunities. Higher borrowing costs remained a constraint, but increased inventory and reduced competition created conditions that were more favorable than those seen during the peak of the market. The ability to negotiate, the availability of options, and the reduced pressure to act quickly all contributed to a more balanced purchasing process. For sellers, the landscape required adaptation. Success depended less on timing the market and more on aligning with current conditions. Accurate pricing, property presentation, and responsiveness to buyer feedback became critical factors in achieving desired outcomes. The strategies that had proven effective during periods of rapid growth needed to be recalibrated to reflect the realities of a more measured market. Investors, too, faced a different set of considerations. The emphasis shifted from short-term appreciation to long-term value, income potential, and risk management. This change in focus reflected a broader transition within the market, where sustainability replaced Arabic seen, Arabic rat, Arabic tain, Arabic ta as the primary driver of decision-making. In the end, the housing market's shift was not defined by a single event or turning point, but by a series of interconnected changes that gradually reshaped its structure. It moved from a phase of rapid expansion to one of adjustment, where balance, rather than momentum, became the central theme. This transition, while less dramatic than a sudden downturn, carried significant implications for all participants, marking the beginning of a new and more nuanced chapter in the U.S. housing market.